Hello, everyone. Welcome and thank you for joining this Centurion Apartment REIT Advisor Zoom webinar with Greg Romundt, President and CEO of Centurion Asset Management. My name is Paul Mayer, Head of Sales, and I will serve as moderator of this webinar, which should last around 30 minutes. Given the large number, all participants have been placed on listen only. I should also like to mention that this webinar is being recorded and will be available on our website by no later than the end of this week. Well, the Centurion Apartment REIT is now $6.7 billion in AUM with an annualized rate of return since 2009 inception of over 13% a year. The REIT is and remains the largest private apartment REIT in Canada by AUM. Centurion owns and operates 152 apartment buildings, student residences, and a few medical offices in 46 cities with over 21,000 rental units. Greg, as always, it's a pleasure to have this time to chat. I guess to begin, the Centurion Apartment REIT declined by 1.2% for August 1st NAV. Would you mind giving us a description as to what lies behind this decrease?
Thank you, Paul. Yes, this would be the first NAV decline we've actually ever had in the fund's history. The 1.2% decline was a net result of capitalization REITs moving up around 8% or 8 basis points, sorry. Although this was largely offset with pretty strong NOI growth, as we'll get to. In terms of attribution, the cap rate move shifted values by about 86 million down and increased NOIs created value of about 70 million. And add in the CapEx spend around 24 and we arrive basically at the NAV change. As you recall, we write CapEx off as we go every quarter. The increase in cap rates in large measure can be attributed, in my opinion, to a significant decrease in transactions in the Canadian apartment sector. While there is a lack of transactions, appraisers whose cap rates tend to, inform our valuation calculations typically become more conservative and as such tend to push cap rates higher. Apartment cap rates have been extremely sticky even in this environment of record interest rate hikes because rents have been moving so quickly and rents continue to press higher. So I have little concern that cap rate trends have changed. Remember as well, when we define a cap rate, it's usually in the range of 4 to 4.25 or 4 3/4, 5%. Like if we already define them in 25 basis point ranges, so widening of spreads given how low transaction volumes have been isn't really unusual. This lack of transactions, however, is by no means a reflection of traditional apartment buyers and owners souring on the sector. Quite the contrary, there's quite a bit of capital on the sidelines waiting for some compelling opportunities to present themselves as we expect developers to be more motivated to bring completed projects to market in the later half of the year. Also, August is usually quiet, but the fall should see some increased activity. And we continue to build capital and await opportunities, the same messaging we've been giving since almost the beginning of the year. Again, we don't get to control cap rates nor interest rates, but we still offset the vast majority of the move with portfolio growth of NOI, which we said was likely a year and a half ago and have been saying ever since the Bank of Canada starts its hiking process. If cap rates go up modestly, we'll get to buy stuff more cheaply, and I think that's a good thing. And the short-term softening in the market is not unexpected and quite frankly will serve us well as we look make more acquisitions in the fall or as they present themselves. This is a long-term strategy and always has been. Even taken on a quarter-by-quarter basis, we're basically flat on the quarter. And year-to-date, the REIT's F-class return is about 4.5%, and A is just under 4. The tailwinds are as strong as ever, but we don't get to control the market waves, only point our sails in the right direction to the wind. And over the long term, that's always been a winning strategy for us.
So as the 1.2% NAV decline was the result then of the appraisal of the portfolio in Q2, given that Q3 quarter encompasses the summer, which is traditionally a quiet period, If there isn't a pickup in transaction volume, do you envision that perhaps cap rates may edge up again?
It's hard to say that this air pocket may persist for another quarter or so, or we could see normal resumption of acquisition activity in the sector in September, setting marks, which would provide more room to update cap rates. We're hearing that a record number of CMHC financings are being done right now. And that's largely because CMHC put up its fee percentage rate. So there's been a huge surge of everyone who had anything maturing or coming to mature, or in the next year putting their applications in to beat those dates. So I think that's actually got a lot of our competitors or the industry kind of focused right now. I think a number of our competitors are sitting on cash. I think quite a lot of it. A lot of them are sitting on cash waiting for opportunities. So for us, this wait and see approach does suggest that we've been does not suggest that we've been completely inactive in the market. We've made a few tuck-in acquisitions where we already had a good presence, or was a second phase or a third phase of something we were already onboarding. In the past 2 months, we've acquired 2 apartment buildings, so it's not huge, but like I said, these are tuck-ins to ones that made a lot of sense for us. One of them is in Gatineau, where we've been building our portfolio, and the other is in Kelowna, and we have a third one pending within the next 3 to 4 weeks in Calgary.
So then, given that you're suggesting that Centurion and the industry at large is expected to regain momentum and transact on acquisitions in the latter half of this year, if the transactions, though, take place at more advantageous higher cap rates, will not these marks value the Centurion portfolio lower?
I really don't think the impact of this deep discount nor value transactions would be so prevalent as they dictate a sustained revision of cap rates across the entire sector. And by extension, Centurion has a very diversified portfolio across the country. While we hope to be able to pick up a few bargains, we expect the majority of the transaction will be more broadly reflective of the strong growth in rents for the foreseeable future. So, like I said, we don't get to control where they go. But long-term performance is going to be driven what's happening underneath to rents and NOIs and execution of the strategy.
But would you care then to address the sensitivity of the NAV's decline in relation to the cap rate rise?
Well, while real estate portfolios are sensitive to cap rate movements, it's even more important to note that cap rates themselves are slow to move and not really prone to wild swings, especially if they are an aggregation of a number of cap rates. Like you say, we're in 46 different locations, 152 buildings. And all of them have strong fundamentals. So I say this to emphasize that Centurion's not focused on any one particular city nor region, and there are other REITs that do that. And the Canadian multi-residential apartment sector is very, very different from office or retail real estate subsectors. And this is something I've been talking about for a while. To highlight, Canada's downtown office vacancy rate has already reached concerning levels. And this is what I've been saying would happen for almost 3 years, with rates sitting about 19% this year. Cities like Montreal and Calgary are facing significant challenge with the respective vacancy rates of 18 and 37%. So I've been saying since Q2 2020 that the office sector was going to be in real trouble. And now that's apparent for everyone to see. So this is now the front page of the newspaper. 3 years ago, I was kind of one of the few people talking about it. But that's offices and retail, and that's not apartments. By contrast, Canada's apartment vacancy rate is about 1.9%. And there are fewer apartments available to rent in Canada than any time since 2001, over 20 years. As a result, Centurion's weighted average capitalization rate has been more or less steady decline from about 5.8 in 2001. So that's 13 years ago now, about 4.1 today. And that's been very supportive of valuations.
Yeah, that is actually quite amazing. Like a decline from 2011 of 5.8% down to Q1 of this year to 4.06. It really shows the resilience of the sector. Now, before though we address the strong subsector multi-residential fundamentals, I believe though it's probably worth us making mention of the strong NOI growth of the REIT.
Yeah, remember the 86 million in fair value was just on moving the cap rate. So this is when we segment attribution, was greatly mitigated by a 70 million gain in net operating income. And this really is reflective of the growth in, or the continued revenue growth from rents, as well as a strong expense management. And cap rates move occasionally, but rents have been moving every single month. So, some stats. So looking at Q2 2023, operating revenue was 187 million, up almost 8% from Q2 2022. Total NOI was 121 million, up almost 12% from the same period last year. And this is same store basis. So it removes the impact of any new acquisitions that fall outside of 12-month comparison. And the REIT's NOI ratio has grown year over year from 42.4 to almost 64.75%. So 2.25% move and NOI ratios, which is really quite good. Should like to know, even with a very sophisticated leasing infrastructure that we have, the portfolio's gap to market rent is about 34 million at about 8.4%. And realize this gap in value is worth almost $800 million in value. You can just show that chart of the previous one. There we go. I think one of the interesting things about this chart here is you'll notice that from year end 2022, we had in the last 6 months the fastest rate of increase in our portfolio gap to rent. And as we've been saying last year, I remember, we've been messaging for about 18 months, consistently, and longer than that on an as-asked basis, what would happen when rates started to go up. And I had said that what we would see would be interest rate increases would actually drive rent increases because it'd be forcing people out of homes and into rental. And on this chart, you can see Bank of Canada announced their first hike in March of 2022. And you'll notice our gap was, growing, but reasonably stable as we put new gap in and we took gap out. But right after they started to increase, our gap just started to explode. And that's because rents have been exploding. And a large part of this is not only, there's a couple of components. Supply is declining because you increase interest rates, you make it harder to build supply comes down, same amount of demand. Second thing is if you increase interest rates, someone who was looking at buying no longer has to either stay a renter or become a renter. That increases demand. Now you, at the same time, have levels of immigration which are far above what our market can absorb. And again, you just increase demand and supply is going down. So, it's almost a perfect demonstration from our own statistics, let alone what the market suggests has happened since the introduction of rate hikes and its impact on us. So that's what I've said. We're a net beneficiary of this policy, which runs exactly counter to heterodox thinking on terms of the direction of interest rates, which I called out would not be the case almost 3 years ago.
Well, you know what, Greg, why don't we actually unpack these tailwinds of the Canadian multi-residential apartment sector, which, as you mentioned, you've been speaking about pretty much since the inception of these webinars, if not before. So, yeah, you wanted to, I know, definitely address it in this webinar.
Yeah. Yeah, I think it's important to, again, take the messaging we've been very consistent about is this supply demand imbalance. We want to make sure people don't lose sight of the strong fundamentals behind the REIT's performance to highlight as incredible it sounds that the supply demand balance is even becoming more acute since our last webinar. So, this is not something that's just getting better. And what I mean getting better in terms of market conditions for average Canadians, it's actually getting worse.
Where should we start? Let's should we start at, we've been saying this for years. You've been articulating this obviously internally, and we've been doing it externally for years, but where should we start? Should we start supply or demand?
Let's start with demand. Most of us are now probably aware that Canada welcomed slightly over 1 million permanent and non-permanent residents last year, which also includes immigrant workers and foreign students into Canada last year. This 2.7% annual growth is the second highest in our country's history and the fastest growth rate of any country in the world, which to me is kind of incredible. What people are probably less aware of is that we added 292,000 more people in the first 3 months of this year, or about 0.7%, for a total of 40 million Canadians. And that's the highest rate of growth in any first quarter in Canada going back to 1972, with immigration responsible for 98% of the gains. And if one were to include the arrival numbers of Q1 2023, the number of new immigrants into Canada is on pace to be 1.2 million for the rolling 12-month period. So the vast majority of these new arrivals rent. In fact, only after 10 years or so do new immigrants reflect the same percentage of home ownership rates as native-born Canadians. Rental demand is driven by would-be homeowners who are priced out of the market. And even though housing prices have fallen in some cities by 20 to 25%, single-family homes have never been more expensive to buy because, from an affordability point of view, because mortgage rates have tripled in some cases. Now it takes 85% of an average income to service the monthly mortgage payment of a median-priced home in Toronto, and a staggering 126% of average income to service the monthly mortgage payment of a monthly median home in Vancouver. The pressures on homeowners are enormous, with various reports saying that 1/3 of mortgage holders are behind their household payments, which is just unbelievable to me, and in negative amortizing or in infinite amortizations. And that represents about 20% of all homeowners. So they can't afford to do that forever. And this is one of the reasons why, I've said, look, these interest rate hikes are non-sustainable and will be reversed. And I can't specifically say when, but I think sooner than most will project it, certainly sooner than the Bank of Canada would suggest. If you could put up the chart of the where we compare NOI and changes in NOI over periods, I think that's instructive. There we go. So you can see how this is borne out. So we saw in 2020, 2021, that was a year when we had the student softness. And what we saw was subsequently, so if you look on the chart on the right, you can see how NOI was short largely in 2020 and 2021 because of vacancy. Many students stayed home and either in their home city in Canada or most likely were overseas because there were restrictions. But what ended up happening is now we brought so many students in, there's stories all over the place about students not being able to get housing at any rate. And so we can see why the NOI growth rates, not only in apartments, which are the dark blue, but the light blue, you can see that revenues like rental rates and NOIs have grown exceptionally strong.
Actually, Greg, I'm really glad that you emphasize the growth of the student rents as well, because we've been focused so much on apartments and we forget one of the ancillary impacts of the lack of supply in general is the fact that poor students, they may get accepted into colleges and universities and they have to turn it down because they can't find any accommodation. So that kind of slides us to supply. So do you want to paint a picture of just how bad the supply situation is, even in the last 6 months?
Yeah, I mean, believe it or not, despite the growing demand for any sort of accommodation, the trend of construction is slowing due to a number of factors. Again, this isn't new news that we haven't been sharing for quite a while, but I'll repeat it. According to CMHC, the rising cost of building materials, a shortage of construction workers, and higher interest rate mean housing starts could drop about 20% year over year, 19% year over year under current conditions. And if inflation persists and interest rates remain higher than or longer than expected, housing starts could drop as much as 32%, down to about 177,000 units. So when you think about 177,000 units against 1 million plus people per year, we're not even accommodating the people who are underhoused today, let alone putting 6 people per unit. Breaking this down, residential building costs are up almost 20% over the past year, according to StatsCan, and up over 51% since the start of the pandemic. Concrete and steel are up about 55 and 53% since Q1 2020. Construction wages increased by about 9.4% in 2022, nearly double the salaries of other industries. And speaking with a contractor friend of mine, runs a large condo company, he's telling me that he's hearing of drywallers, or has some drywallers are making over $300,000 a year. Not to undervalue that, but that's a lot of money for drywall. And that's part because we just can't attract, or we're not attracting or even immigrating the type of labor we need to address the housing crisis. And, governments aren't making it any easier. A third of development costs are made up of government fees and levies. And even CMHC, as I mentioned earlier, is increasing the fees by 60% for affordable housing development financing programs. So we're seeing this impact on developers through our mortgage book, as very few deals as they're presented to us make any financial sense. So they're getting turned down. We're approving very few projects today. Number one, because we're very cautious with our capital, but also because even deals that we like, because we like the developer, location, building, all those other things, the financial, it doesn't make financial sense to actually go forward with the project.
And so, putting the supply demand imbalance together, what is the net impact? I mean, I guess it remains still an incredible imbalance. What do you convey now?
The net impact of this massive supply imbalance is making for historic accommodation shortfalls now into the future. So, it's predicted that while Canada needs 6 million more housing units by 2030, so just 6.5 years away, it's predicted we'll only build as a country about 2.5 million, leaving about a 3.5 million housing unit shortfall. Other studies suggest we need an annual pace of construction in Canada of 750,000 units a year, and are only at best doing 250. I think we will end up at less than 200 this year. So we're literally producing a third to a quarter, a quarter to a third of what we need as a country. So, and to give you a scope of the investment dollars required, just very conservative for 400,000 per unit. That means in the next 7 years, we need 2.4 trillion with a T dollars in housing construction. And, I honestly don't know where that capital is going to come from, particularly at these interest rates. So, I think this just the pressure just continues to increase. In relation to the needed apartments, it's even assuming 30% of Canadians rent. This means we need almost $750 billion in apartments, or $72 billion of this a year. That's a very tall order when you consider the entire capitalization of the REIT sector is less than that. 1 year's capital formation required is less than all of us put together. So yeah, it's just incredible.
It's truly is sobering. It really, really is. I guess, of course, no Centurion webinar would be complete, of course, without your thoughts as to where we are in the global macro landscape. So, Greg, where do you see us right now?
It's a good question. I have not changed my basic thesis on, that world governments will be funding a great many initiatives: housing, reshoring of international supply chains, infrastructure, refunding or rebuilding of the West military, and the so-called green initiatives. This will require massive amounts of capital, which has been resulting in large deficit spending. And as an example, the U.S. is currently running a 9% GDP deficit. So I think there's a lot of belief, and certainly mine, that one of the reasons why the economy in the US hasn't imploded yet at these levels of interest rates, not saying it can be said of Canada, is because of this massive amount of stimulus that's getting put into the market. So the world is straining under this massive debt burden. It's made worse by high interest rates. And the situation under high interest rate is set to get worse, as 50% of US government debt is poised to reset at vastly higher interest rates over the next 2 years. I warned about this about 18 months ago, that rate hikes were unsustainable, as even if central banks may be fine bankrupting Main Street, i.e. you and me, and bailing out Wall Street, same as it ever was, it's the really big daddy government here and their debt service costs, which are exploding. And as I said many times, you can't fix the supply problem by jacking up interest rates, which just choked the creation of supply in the first place. That's been a message I've been hammering on for a year and a half, and it's continuing to show up. As a result, I still believe that central banks will be forced to lower interest rates once they break something, which could still be the U.S. regional bank sector, which in my opinion is a slow-moving bank runner, as we call it, or the nomenclature today is not a bank run, but a bank job. The only way out for world economies to inflate this way out of the debt, and I, for one, see the world going back into a situation similar to the post-World War II period, with inflation in the high single digits and interest rates in the low single digits. And that means essentially negative real interest rates and financial repression. This, of course, would be particularly beneficial for consistent yielding hard assets like apartment buildings.
So I guess that was, by the way, very interesting, Greg. I guess now in closing, putting it all together, what would you say, everything that we talked about, what would you say are some of Centurion's value-added features?
That's interesting. So I was recently asked this, and I said more or less the following. First, with regards to global peers that are broadly diversified, many have other asset classes which have been crushed: office, retail, hotels, or geography, New York, San Francisco. So being in the right asset class helps a lot. Being in a geography that has a consistent and unsolvable housing shortage certainly is a large driver. In other words, we've had a tremendous tailwind that we've been able to use in our favor. Second, we spent a lot of time thinking about how to do things better. Experimentation, even though not everything works, admittedly, means in time you do get better as an organization. Your systems get better, your people get better. And this is reflected in areas like our acquisitions, our lending, leasing strategies, to name just a few. Not to mention what we do on the operational side. And, third, a philosophy I've used throughout my entire career, including, more than a decade pre-Centurion, is to be where others aren't, to be there a little bit early and to capitalize on opportunities that others aren't focused on. In other words, you need to look at the big picture, macro stuff, which I really enjoy, and to decide where and when to allocate capital and when to hunker down. Right now, we're getting ready for the next opportunities, just like we were in earlier part of COVID. There's many similarities there. Fourth, our strategy and structure plus top-down macro lenses allowed us really to pivot where opportunities are and away from risks. Like, we can chase development JVs or lending or value add or new assets and opportunity, going for the best risk-adjusted return at any point in the cycle. And many funds don't have that flexibility, so they really can't pivot in the same way that we've been able to. And fifth, and this is a really important one, you need to be able to find sustainable advantage to win consistently. Can't win by being the highest bidder at property auctions. We need to find ways to outcompete in our lending and JV strategy has been critical in this regard. And we've talked about this for years. You got to build long-term partnerships, builders the product you want to own. And we have a low-risk way with high barriers to entry business model that has allowed us to have, to grow by being the one or one of few parties at the table rather than 1 in 20. Our ability to advise, finance debt, and or equity, commit quick, manage, lease up, partner long-term, or buy at the end has been a great source of sustainable advantage that hasn't yet really been diluted by competitors for much, not much for various different reasons. And six, solid risk management strategy. I started my career learning the hard way about funding risks when I ran foreign exchange portfolios and saw more crises than most people see in their entire lifetime because we traded in so many countries. Like I ran virtually everything, every country in the world at one point. So there was always a risk there was always a crisis somewhere. Whether it landed in the paper here or not, there was always a crisis somewhere. And this is one of the reasons we didn't get hammered on the rise in interest rates, because we locked up money for the long term when we saw it was inexpensive and didn't bet at all with no hedge. We built a mortgage book such that if short rates rose, we were a net beneficiary of this. And we talked about this for years, but I'm not sure everyone understands that benefit. With our mortgage loan portfolio today yielding, call it 13 to 14%, which I think is pretty attractive. Lastly, building teams that can execute. We train our people and let them execute. So no one person is the critical cog in a fragile engine. While I may sit atop this organization, I'm not the main driver of the organization in terms of performance at all these different levels. I mean, there's almost 160 buildings, so I'm not doing everything there. We're still very much driven by building systems and teams and a culture focused on excellence, and then allowing our people to execute. And that's how you get there.
Greg, these are actually really wonderful insights to end on. Once again, thank you so much for your discussion into the REIT, the Canadian multi-residential apartment sector, and the global economic landscape. It was definitely timely, and it's great that we did this, even if it's in the summer, just to give everybody a very timely update.
Oh, one more thing I want to mention, Paul, before we go. I don't know if we popped up this one chart. I think if I pop up page 6, a gap to market variance analysis, which I think is very interesting. This is actually a new piece of analysis that we're going to start publishing, which hadn't done before. What we're trying to show in this chart is, changes in the gap to market and what's happening, because very often when we've looked at the other chart, all you saw was it's going up or it's going down. And what we've started to track as a metric so that we can publish it is what are the movers inside of that. So, we start with where the gap was in the previous period and then show, well, how much did market rents move? How much did we close that gap? So new gap, closed gap from realizations, minor changes from acquisitions. Like I said, when we buy, we usually mark our market rents as zero, even if we do believe there's a gap. And then that comes out to, our total gap. And so you see in the quarter, in this last quarter, we drove market rents by almost $9.5 billion up, but we realized about 3.4 million of the gap from last period. So remember what that really is saying is not only did we move our gap up in total by 6 million, but we removed from the gap or executed or closed the gap. That really represents, almost $12 million in gap value, right? When you consider the market rent moved up, but we also took out 3.5 from realizing it. So it's really an interesting analysis, and we'll be publishing those going forward, but I thought it was worth mentioning.
No, that's really interesting. Actually, I should just sort of highlight that we do publish public markets level analysis, even though we're a private REIT, on our website. We have excellent quarterlies as well as an audited annual general report. So we obviously encourage all advisors to check them out on our website. Well, once again, Greg, thanks so much for all this insight, especially during the summer. Obviously, we'll have another webinar in the fall. Well, on behalf then of Greg, your sales team, and everyone at Centurion, we'd like to thank you, the advisor community, for your time and continued support. It is greatly, greatly appreciated. Of course, should you have any follow-up questions, please do not hesitate to contact myself or your wholesaling team. Once again, thank you so much for your time, and everyone, have a great day.